well, it's time.
I didn't have an option.
No.
I had no choice.
I wasn't asking because you had a choice.
Yeah.
Welcome to Freightonomics, everybody. Right. And what a Freightonomics week it's been.
Yeah, if there ever is one, this is it.
So welcome to Freightonomics. I'm Zach Strickland. And
I'm Anthony Smith.
And then you'll notice, for those of you watching us on LinkedIn or the internet of your choice, we have Seth Holm joining us today. Welcome, Seth.
Thanks, guys. Thanks for having me.
Yes. So Freightonomics is the show where we discuss the topics that are relevant to freight and the economy and how they are both interconnected, hopefully presenting it in a very approachable way. Hopefully. Yeah. Give us feedback on LinkedIn. Anthony is monitoring all the comments right now.
Yes.
Anybody that's watching live, please feel free to chime in and jump in there and let us know how we're doing, whether or not you agree, disagree, or just think that you don't like rain.
There's some questions.
Yeah. Questions, answers, any of it. So Seth Holm's joining us today for a specific reason. For those of you that have been watching the Freightonomics or listening to the Freightonomics podcast, we do try to cover, we're doing a series about basically like a 101 of freight.
Yeah.
How does
this all work?
How does this all work? You know, if you've seen the website, How Stuff Works, or watched the Discovery Channel, or what TLC was supposed to be, I'm kind of an edutainment geek. Did y'all watch those shows or any of it early on?
I know where you're going with this. I love learning how stuff works. So
Yeah.
I'm on board with that.
I literally cannot stop figuring out how some of this obscure stuff is. I will go down rabbit holes on the internet all the time. That's
YouTube rabbit holes are the best though.
Oh,
like
man.
it gets
I get
3
lost.
hours, 4 hours, the entire day's gone.
I get lost in all that stuff. So, we're trying to make, do a series where we give you insight, especially for those of you that may be new to the industry or maybe work in a specific segment, and you're curious about other aspects of it. We get siloed up in our companies. We get siloed up in our careers. We start working down a certain path, and the longer we're in it, we get more specialized, and we kind of lose that visibility to what's happening around us, and it's crucial.
Yeah.
Especially as we're learning in today's world. If you don't have understanding of what's going on outside of your box or your cube or your building, you might be missing out on a lot of opportunity, and also you might be exposing yourself to a lot of risk. So on that note, Seth Holm, former Equities Fund side guy that managed the hedge funds and basically knows all things finance.
Money.
Of course, finance. I was a finance major. Finance 201 essentially says risk reward, and that's what we're going to talk about a little bit this episode. I felt like it was the right time to bring on a guy that has a pretty deep understanding. Give a little background on yourself, Seth. What did you do in your former life?
Yeah, so I also was a finance major. I just moved up here from Atlanta. What was it? Close to a year ago now. Prior to the transportation here at FreightWaves, I'm going on my 13th or 14th year of working. I spent the first 4 at a private wealth management firm, basically helping wealthy people manage their money. And then I went to the hedge fund side, and there I covered and helped manage a portfolio. And I was a generalist, which basically means I look at everything, but I really focus most of my time on consumer and TMT, which is tech, media, and telecom stocks.
Very appropriate for where you work today.
Yeah, there are some similarities, but stocks are stocks, and it took probably 6 months for me to get up to speed and feel like I kind of had my bearings a little bit, but because it is a lot different at the same time. We can get into that.
It is a crazy world with which we live in, and that's funny to hear you say, because I was a finance major as well.
Mm-hmm.
I walked into transportation thinking, oh, this will be a cakewalk. I was finance and transportation, not traditionally thought of as this complex environment, when actually it is extremely complicated, and it has a lot of variables, a lot of moving parts. It actually may be more complex than the financial sector, if you think about it operationally.
I think it depends on which sector of finance, but yes. The other thing that I find interesting about transportation is a lot of it is like non-intuitive. So I'm like, wow, that's not the way I thought that would work. And then,
Don't get me started on the terminology in the industry.
right. So
there's a lot of things that have been around for several years, and they've been turned into words that they don't necessarily mean anyway. I'm not talking about you accessorials at all. It's, Anyway, so I want to get started on the show, and, the stock market itself has gone haywire. As this pertains to those of us in the transportation world, obviously, if you're at a publicly traded company, there's an obvious connection here. You're working at one of these big carriers or big brokerages that are publicly traded. As the stock market goes up and down, your management has to take that into account in its day-to-day operational, what it's giving you as direction. So, and the reason for that is simply that there is, that's their purpose. These people are investing in your company. You have to create inherent value, whether or not that is in your control or not.
Right.
So, Seth, my first question to you is, you're at a JB Hunt or a Werner, Schneider, some of these big publicly traded companies, U.S. Express Covenant in town here in Chattanooga. How do you view what's going on with your stock price right now? Do you have to take that into account, or do you need to just kind of buckle down, keep with the program and move forward? Like, how do you deal with that?
Right. Well, first things first, I think that the stock market is 20% off of its highs, and it's sold off so far so fast because the market is pricing in a very increasing likelihood of a recession. So in this case, yes, I think you very much need to pay attention in your stock price. Not only that, the bond markets, you've got 10-year bond yields down to 75 basis points. They hit 40 basis points the other day. The whole entire treasury bond curve is below 1%, which is insane. And generally that only happens when the market is telling you, the market hates uncertainty. That's one thing that's going on right now, but they're also telling you that forget about backward looking indicators, things are going to get nasty over the next couple quarters. So I think if you're one of those management teams, I think you start planning around how do we manage this business through a difficult time and a period where we could see, maybe it's just 2 quarters, but we're definitely going to see a big hit to economic growth, even if it's only for a quarter or two. So I would start in terms of, whatever you can do to tighten up your expenses. Maybe you cut your CapEx, hold off on the new truck orders, try to manage on the revenue side, have as much contract revenue as possible. This is kind of interesting because right now you have this really odd divergence right now, I would call it, where trucking is booming. And a lot of that may be because of the fear and the panic and the destocking that you're seeing at places like Costco, and everybody runs out and buys $500 worth of toilet paper and
paper is
ramen noodles and bottled water and everything else. I think that may be artificially inflating volumes. This is my personal view, not a firm view, but I think that we'll probably see a lot of this optimism in the near term in the trucking markets turn around and take a hit along with the overall economy.
Yeah, I think you're making a good point. So something that the stock market is very speculative.
Right.
That means you're looking forward, you're looking into the future, and you're making a guess, an educated guess sometimes, not always.
Yeah.
Sometimes you just have a feeling that you're trying to fulfill. And that's what moves the stock up or down is basically, you were a fund manager.
Yeah.
So you're sitting in your fund manager seat and you're seeing all these other stocks go down, but you see that U.S. Express is actually having a great time of it in March. How much do you value? You just said it yourself. The trucking volumes are moving. There's absolutely no data to support the fact that outside of some, other macroeconomic indicators, that this is going to change.
Right.
You see the coronavirus is creating a panic. The media is covering it extensively, such as we are. And, whether or not the virus actually has a true life-threatening implication or if it's really just a cold
right.
that everybody's overreacting to, it doesn't matter because the reaction is real. And at some point, people may shut down and stop consuming goods. They'll eventually have so much toilet paper, they won't need it.
You will have pulled forward 6 months to a year's worth of toilet paper.
Yes. So what that's going to do to the freight market is you're going to see this big bow up in the front in March, which is what we're seeing right now. A lot of volume moving, a lot of, we've had a ton of inventory. But again, coronavirus may move through the United States in the next month and then subside. We may see this bell curve type spike and then it goes away. And yet, giving the Chinese inventory stuff enough time to replenish, et cetera. So what data would you look at that suggests that they need to continue to be super conservative, other than the fact that we're relying on, some of these, the bond, the yield curves, things that traditionally signal recessions. These are financial instruments based on a lot of speculation, but not necessarily what's happening right now.
That's right. Yeah, I mean, both the bond market is thought to be the smart money and is generally more accurate in terms of economic forecasting than the stock market. A lot of people say that the stock market has forecast something like 10 out of the last 2 recessions. So people they don't like to lose money, so they get very trigger happy and they panic out in the stock market. I think caution makes sense here because one thing that's crazy about this is it's just so uncertain. So this is one thing I talked about with Craig on our coronavirus special. You can't go out there and easily put any numbers around whatever the impact to companies' revenues, cash flows, and profits is. You can't do that to GDP because we don't know. And so I would just be cautious if I were running, a big transportation company. And the thing that I would say is, we're likely going to get, whether it's 2 weeks or a month, again, my personal opinion, I think most people are going to be working from home, which is naturally going to cause at least a significant near-term decrease in consumer spending. I think companies like Amazon will benefit from that.
I was going to say, because a large percentage of our purchasing, especially throughout the year, I think we actually saw a trend reversal this past Christmas and holiday season where people were actually picking up in the store a little bit more.
Right.
But still, there's this, everybody's consuming more online. You can get on Amazon Prime and just hit the button.
Yeah, and you don't want to go out and shop at a brick and mortar store where you might touch something that infects you or come into contact with someone who's had the coronavirus or been exposed to it. So, I think that really makes sense. And so, on the transportation side, if we are going to have, even if it's only a temporary, because I would expect a V-shaped rebound to the economy after a couple quarters once this thing gets contained or blows over. Now, the nightmare downside scenario, in my view, is if we get another outbreak in China and this thing reaccelerates in terms of the case counts, then I think that the bottom will probably fall out of the stock market. But I'm not betting on that to happen. But if I were a management team, I would just be preparing, just have your recession playbook, whatever it is for your business. If there's going to be a downturn, how do you optimize performance and limit the downside to your business?
Right. So, the big takeaway here is basically be ready for anything, but it's going to be hard, I think, having been in that space for a little bit. You've got this surging volume right now, and I know we're all prisoners of the moment. Yeah, we're all prisoners of the moment. But also one of my favorite people to, my finance professor taught me, so therefore I just took it all in. Warren Buffett.
Yeah, sure.
These times, actually are discounts. They're basically giving you the opportunity to invest in something for long-term value. Again, the world is far different than it was when he wrote his book back in the late 90s. But, I've always been a kind of believer in that value investing. So my question to you is this, I know on your day-to-day operation, you need to be more conservative and mindful. You need to be able to handle some of this surge right now, but plan for that long-term kind of, maybe volumes are going to decline, et cetera. But how do you take advantage of kind of that mentality? You've got this, everybody's planning for a recession. The market's reflecting recession. This should have a deflationary, obviously if you're looking to get a mortgage right now, you're looking pretty sweet.
Yeah. Although those haven't come down to the degree at all that they should have, given the way that the 30-year bond yield has fallen.
Right. And I think there was a little bit of support from the Fed on this to kind of increase or keep it at least somewhat elevated.
Fed fund rate, right?
Well, Typically I think there's a spread. It's about 150 basis points between the 30-year bond and the 30-year fixed mortgage rate nationally. And
Right.
if you look now, the 30-year bond, gosh, I don't even know. I want to say it's like 80 basis points, whereas the average nationwide 30-year mortgage is still only like 3.5%. So that spread is blown out to like 270 basis points.
Right.
And, I think over time that will come down as, these rates prove longer than
A little
temporary,
bit more stable.
and
Yeah.
then you have that competitive sort of prisoner's dilemma where one comes down and all the rest have to
Gotcha.
match them.
Gotcha. So
We have
yeah.
a comment here.
Oh.
Timothy Dooner asked, "What should I be hoarding?"
Is there anything? I mean, that's actually a really good question. As we're as people are obviously out there, not everybody is panic buying,
Right.
but this is a good environment for buying certain things and selling certain things.
Right.
What exactly would you be looking to get a good deal on? I mean, obviously you're not going to buy toilet paper, but at the same time, I would love to know, do you invest in Charmin at this point?
Yeah. Yeah. So that's tough. If you look at the best performing stocks over the past, call it 3 weeks, when this correction, you've had so-called stay-at-home stocks is what they've been dubbed. Those are things like Netflix, all that kind of stuff, consume more media. The other things are classic recessionary defensive. So healthcare, utilities, consumer staples, things like that, where their revenue isn't going to contract much, even in a recession. It might even grow.
Sure.
Dollar stores, that type of thing. And then, the opposite of that right now, it's interesting because everybody's all focused on balance sheets again, which is crazy because just a month ago it was, we have this
Growth model.
bubble in
Yeah.
venture capital and
Yep.
companies losing, untold amounts of money. And now all of a sudden we're like really focused on balance sheets again. So it's crazy. It is kind of, I wouldn't liken this decline to 2008. It has been in terms of severity and how rapid it's come down. It does remind me of 2008, but like, it just shows you how fast sentiment can change. It's crazy.
Yeah, that's insane. Sentiment, Anthony's favorite thing.
In terms of, are you asking me what I would buy right now?
Yeah, like and not necessarily the recessionary defense stuff. Like,
Right.
I mean, we're talking about things that you are getting a good deal on right now that you think may recover. Again, you're not giving investment advice, but
Right.
I mean, if you're an outsider, you're not licensed to give investment advice, et cetera, but
Right.
you could be, you're looking at this market from an outside objective perspective.
Mm-hmm.
What do you think are some of these things, especially, these transportation companies, they move commodities. They're very specific with
Right.
what they move. A lot of them are very shipper specific. So you're looking at Procter and Gamble's and the Nestle waters, things of that nature that are being hoarded, but
Right.
they could be captive by the market itself moving downward.
Yep.
That is really disparate from what the actual end result will be, because people aren't simply trading on,
Yep.
well, I think everybody's buying water right now.
Yeah. They're not looking out forget 6 months. They're not really even looking out 3 months or maybe even 3 weeks. They're looking right now.
Right.
Yeah. So, I mean, what I would say is, so there's two types of people in my old industry. You've got the deep value guys, the guys that like to go out and try to buy companies for below their book value or their liquidation value. They want to buy when there's just blood in the streets, right? I want to get this company for 50 cents on the dollar that I don't think is going to go out of business. And whenever, this thing passes, it'll get re-rated higher, right? I'm kind of the opposite end of that spectrum. I would take this opportunity to trade up in quality. So I would want to buy a high quality company that has secular growth characteristics and a good margin structure and good returns on capital. Because right now, like, for example, why would you be, and I don't want to pick on the cruise stocks, but why would you be out there bottom fishing in cruise stocks when their livelihood is severely threatened right now? And I think even yesterday, President Trump talked about maybe having to bail them out. Why would you be buying that right now rather than something that's a strong a really great company that's going to grow for a lot of years to come when that's also trading off 20 or 30%. So that's what I've been doing. I'm not going to give any individual companies.
Right. You can't do that.
But I would be looking to things that, and then also just in risk reward, I would be looking for things that can survive a downturn if we get one, or thrive if we don't,
Right.
So just try to protect your money.
And the reason I ask that is not necessarily for investment advice specifically, but for those carriers and brokers out there that are moving this freight. This is the type of company that you could be potentially, really putting a stake in. You've got an option this month. You're going to have a lot more optionality this month that may not be there next month. And, some of the stuff that we look at, is showing us that, volumes are going haywire right now, and it's going haywire all over the board. It's not just one market. It's 75% of the freight markets out there that are going crazy. So if you you need to be cognizant of this kind of stuff when you are out there, on the brokerage floor, the carrier floor. What types of commodities, what type of shippers are you moving right now that are going to be, more consistent, more stable, just like Seth does with the financial markets, financial companies. Those are the ones that are going to be, you can budget for higher volumes of freight in the near future. But also to that same point is that you should be seeing declines in those that you would intuitively just know aren't going to have as much volume. Obviously your service companies are not shipping a lot of freight, but
Right.
But that's kind of the mentality that you need to adopt is what's actually going to have something of survivability, long run viability, as well as those that are living in the moment right now, that are going to see the seasonal depression, if you will. So Seth, I know your time is valuable, so I don't want to take up too much of it, but thank you so much for hopping in.
Of course.
On the moment. This is a crazy time, and I think like everybody, they're watching that stock market go up, down, 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 down,
Right.
and just really confused by it. So I wanted to bring you in and let everybody know that there is a connection between the two and how to operate with that. So thank you.
Right. Thanks for having me, Gus.
Yeah.
Yeah.
Right.
Do we have clap? We need applause.
I know. I wish we had applause.
Oh my. Emma?
Yep. Oh, Emma's giving us
clapping.
applause.
Okay. All right. She's always here for us.
Yeah. So Anthony, I mean, I myself am always a little hesitant to watch that sentiment as Seth was talking about, but it does have an impact in the market. I will give you that.
So two things, Zach. Many of you already probably know. They don't know. My birthday's on Friday. Guess what also comes out Friday? Consumer sentiment.
Is it Friday the 13th?
Yes, it is.
Oh man.
It's going to be a great day.
All the things.
It's going to be a great day. But sentiment comes out on 13th, so it's like a little birthday gift for me.
So consumer sentiment.
Yeah.
Tell us what goes into that.
How people feel. No, there are different components. So there's one from the University of Michigan, and there's one from I think the Conference Board. One is they measure things a little bit more differently. I like the one from the Conference Board. That's not the one that's coming out. I like them both, but I like to lean on that one a little bit more. But it has different components on like how people feel towards their current condition and their outlook for the future of the their outlook for the country, and so how confident they feel about things going forward. And so it's safe to say from some of the stuff that I've read from you, especially your latest chart of the week, really kind of seeing all that consumer pull forward. And one of the things we just chatted about here is I'm really curious to see if how that pull forward affects everything in the next month or two here.
We have got the definition of uncertainty. Seth was talking about uncertainty as being something that panics people, and that's that's our human nature. It's evolutionary. We have been bred to fear it and react to it, and that's a survival instinct. It is within every single one of us, sociopath or not, and that's the reason that we exist. And so we have to recognize it. As much as I kind of, give you grief over it. It is a part of who we are, and it is a part of markets. And like I said before, I believe that the coronavirus is some sort of significant virus, disease, threat, health issue, etc., or don't. The reaction is real. And we're seeing that reaction in our freight markets. We've seen volumes surge. We've seen capacity tighten in a time where we don't necessarily see that. And so I think at this point, looking at the consumer sentiment, this next Friday's release, actually I'm going to be paying attention to.
Yes, I'm going to be curious.
Yeah.
I'm going to be curious. The other thing is the latest with the coronavirus. I don't know if you saw it, but it just got upgraded. I don't know if that's an upgrade.
What?
But the World Health Organization.
Did they call it a pandemic?
Yes, they did.
All right. Yep, I did see
Is that
that.
an upgrade or a downgrade? I don't know.
Well, depending on your perspective, it's
Right?
if you're a virus, I guess on the virus team, you're like upgrade.
Yeah, you're cheering for
Yeah.
that, right?
If you're not on the virus team and you're a person, you're
Yeah.
like boo.
yeah, I can see that. I can see that.
Yeah. So yeah, this is, it's a wild ride, and we've talked about things. I should have, we didn't have enough time with Seth. I wish we could have had a little bit more, but there's things that he was talking about that are inherent to financial markets that don't necessarily exist in transportation. So, just like I was talking about with you're trying to figure out how to manage the rest of the year. How do I weather this? Obviously I'm having a great time right now. Volumes are up. People are buying toilet paper, and I'm Procter and Gamble's number one, carrier.
Yeah.
Having a great time. They're number one broker. I know they use brokers quite a lot, but this is going to dry up. It's not going to sustain.
Yeah.
I don't think a lot of carriers out there are looking to invest in trucks or equipment right now, but they're going to see this balance sheet or their income statement here in the next couple of weeks.
Yeah.
And they're going to think, oh, we had a good month.
Yeah.
We had a good month, man.
Yeah.
Maybe we can afford what we only budgeted for this % growth in March.
Yeah.
Man,
Yeah.
they may be in for a shock. Now, they may also make the mistake of applying this growth to June.
That'll be rough because that's an issue if you're not able to really modulate and shift kind of your forecast as things kind of pop up along the year. And I think we're seeing is like a blip in the business cycle, and this blip can really kind of throw off all the other forecasts if you don't factor it correctly.
For anybody that makes budgets, as I have in the past, nightmarishly so and inaccurately, you'll know that this process is very awful, for just lack of a better word. It's very inaccurate. It's it's a necessary evil, if you will, and we have just blown the budget in March on the high side. We're going to more than likely, but what does this mean for the rest of the year? Now, obviously, FreightWaves, our company, has, this is why we were built, not to be too, pimping of our stuff, but, this is why we created what we created. Obviously the Sonar platform is there to give the data to do it. And again, I'm not going to turn into a salesperson, but
And you also have the futures to hedge.
we have freight futures. This is
what it's made for.
again, if I were not in the chair I'm in, if I'm not wearing the FreightWaves gear today,
Yeah.
this is the argument for reasons for freight futures right here.
Right.
This is for anybody that's made a budget and has dramatically failed at making that budget.
Yeah.
Those freight futures can, this is the instrument that stabilizes your world. I know coronavirus isn't going to happen every year.
Yeah.
It's a once every 100-year event type deal. But here in the next 18 months, something else is going to happen.
Right.
And if you look at any of the spot market rates, any of that volatility there, you're going to see that you can't apply last year to this year.
Yeah.
If anybody tells you they know exactly what's going to happen in June,
Yeah.
they're lying.
Yeah.
They're lying. They don't know. I
Yeah.
mean, there might be a person out there that gets it right. That's going to be your 1 in 100 person. It's the guy that fills out his March Madness bracket, topical.
Yeah.
And gets them all right.
Yeah.
It's not because he had that much more information than anybody else. It's just he literally just was able to throw a dart blindfolded and hit it once.
Yeah.
So yeah, I think we are in that, a very obviously for us in the as analysts and economic advisor type role, we're kind of thrilled and terrified.
Yeah. Yeah. Yeah.
It's exciting to watch this kind of volatility, but also extremely unnerving. But there's a lot of stuff that you can do to hedge this. And I think information is always the thing that I rely on. Of course, as an analyst,
Yeah.
you're an economist.
Right.
As much as you like the feelings, I don't think that you're going to ever just say, "Oh, I feel like today's going to be a great day in the stock
No,
market."
you're gonna have to bring some data with it as well.
You got to have something
Yeah.
to hedge that with. So, bringing it back to transportation a little bit and how this is going to be relevant, on the financial side. So there's a few things that, we talk about carrier brokerage, transportation spend, et cetera, that you monitor. We have income statements and balance sheets and all that. As Seth was talking about, everybody's looking at balance sheets now. That's what everybody does when they get conservative. And the reason for that, do you know what the reason for that is?
Zach, what's the reason for that?
So the reason is a balance sheet shows you what you have.
Yeah.
That's what you got.
Yeah.
It's your assets, your liabilities, your equities. It's all the stuff that makes you you. So if I'm looking at Anthony today, and your balance sheet would be your experience, your clothing, your health, your mental well-being capabilities. It's what you have today.
Yeah.
This is what we're looking at. It doesn't care about what you're going to be or where, necessarily where you were.
Right.
It's what you are today. It's your physical snapshot of what you are. And that's what a balance sheet is. It's saying, if you're a carrier, this is how much if you were to sell this company today, you would expect to be right around this number here.
Right.
You add up assets, subtract liabilities, equities, and then there it is.
Yeah.
It's there's your number. That's your book value, et cetera. So if people are not valuing things on your inherent value, they typically are expecting you to grow.
Yeah.
And that's a lot of what has happened over when the economy's booming, they're going to value you over what they expect you to be.
Yeah.
Not what you are today, but what they expect you to be.
Yeah.
And
It's like starting a new job, right?
Yep.
Start a new job, you get ramped up.
You're
Like, you're not going to just maybe knock it out the park from day one. Maybe you will. I don't know. I have faith in you. But
thanks.
there are things that you got to learn. Day one on job training. Your potential has not yet been reached.
Yeah. So some of these financial measures that people look at, I'm going to talk about those a little bit. I'm not going to get too deep into the accounting, but this is the type of stuff you're going to hear in these earnings reports, these earnings reviews, things like EBITDA.
Yeah.
You know what EBITDA is.
Earnings before. What is EBITDA?
Go ahead. You were starting.
I don't. I have no idea.
Earnings before interest, taxes, depreciation, and amortization.
I hated EBITDA.
Yeah.
I hated
So effectively what EBITDA is a way to measure your operating value.
Yeah.
This is what happens when a truck goes. Now, again, it's a little different in transportation because they do include depreciation to an extent because there's so much value in the underlying asset in that company. So that is an operational expense.
Yeah.
So they will take that into account because that truck lease or truck payment does cost. That's a cost of operation.
Yeah.
So they need to incorporate in that some way. It's kind of like operating ratio.
Mm-hmm.
So think about it in other industries. It's definitely like operating ratio. How much do we get, for every dollar that a customer spends on our goods or services?
Mm-hmm.
And that's what EBITDA is.
Got you.
And a lot of times when people are investing, they're saying, we're going to value you as 7 times EBITDA.
Mm.
And that's how that works.
Gotcha.
Is there, and there's no real math or science behind, why 7 times is the magic number. It's basically just accepted that you're going to, as you are profitable and you're making money on your operation, you're going to have the potential to grow over the next several years, and you're going to get a return on that.
Yeah.
So it's basically your operational effectiveness.
And if I'm not mistaken, EBITDA is a relatively newer term, right? Like over the past maybe 50 years? Maybe?
Yeah. I mean, as people have, it used to be EBIT,
Mm-hmm.
earnings before interest and taxes.
Yeah.
Again, there's different depreciations and creative accounting that you can do to kind of
Creative accounting.
Yeah. There again, I'm not suggesting illegal accounting. I'm just saying that there's always loopholes within the boundaries of the rules and regulations that can make those numbers look a little different. Maybe better or worse, depending on what seat you're sitting in.
Yeah, one of the things you mentioned was operating ratio, right? And
Yep.
that was one of the things that, of course, operating ratio is important to every business and it's critical, but freight industry is like a whole nother level. Like you are really
Yeah. So
Every
there's
small percentage point.
yeah in the transportation industry specifically. There's industries out there that are high ORs.
Yeah.
Like the software industry.
Right.
Lots of OR
Right.
because they can make a 50, 60 OR because all the cost is in the upfront development.
Yeah.
So over time, if that is a successful product, it's all sunk cost already. Your OR goes up every year because
Yeah.
you're basically customer service, some level of maintenance, and then it's just gravy.
Right.
So that's where your OR goes way high. Your overhead is super high. But in the transportation industry, every single day, you don't get to, there's no real scale there.
Yeah.
You're running that truck, you pay that driver a variable amount. So variable costs are actually very high in the transportation industry relative to other industries with high operating ratios.
Gotcha.
Or low operating ratios, I should say. Every truck, and most of this is driven. Operating ratio, again, is basically how much money you make for every dollar that a customer spends on you.
Mm-hmm.
So if you have a 93 OR, you're making 7 cents on the dollar
Gotcha.
for every dollar that the customer's paying you to move that truck from point A to point B.
Right.
And that's excluding interest, taxes, things of that nature that are kind of not totally involved in the operation.
Yeah.
So it's operational efficiency, if you will. So yes, the transportation sector is traditionally low, operating in the 90s for the most part. Some of the more successful companies are in the 70s and 80s. I know Old Dominion and Knight Swift both dabbled in that. Heartland does a pretty good job too.
Yeah.
You're looking in trucking companies. But brokerages also have traditionally a higher OR. Now theirs is a little different because most of their operating cost is overhead.
Yeah.
It's just people and technology.
Right.
And the technology is a depreciable asset.
Yeah.
So the longer they have those systems in place, they do. It's kind of like a software company. They did a little bit of a expanding margin on it. The problem is it's not like a software because they have to constantly, that's their value prop.
Right.
Because that technology gives them automation, makes them faster, et cetera. So yeah, those are some of the, common terminologies that a lot of these investors and financial side companies will look at. Private equity, for instance.
Yeah.
So we talked about corporate finance, like on the highest of levels with Seth. There's also another level of this in the private equity investment side. It's, you've got VC, which is venture capital.
Yeah.
Those are going to be the people that will invest in a company that's new. There's a different philosophy there. They basically say, hey, we're going to give you, $10 million to get started.
Right.
We're not going to be heavily involved in general. We believe that you know what you're doing here in the initial phase. And there's not a lot of that in transportation, not in, at least in the asset-based side. There's more of it in the brokerage side, but less so than there was a few years back. Most of the venture capital money goes into technology, kind of emerging stuff.
Yeah.
But in the transportation sector, we have private equity. And you know what private equity is.
What is private equity?
Okay. So private equity, basically, they're investment banks.
Yeah.
That's what I wanted to be when I grew up, was an investment banker.
Now look at you.
Yeah, look at
On
me now.
Freightonomics.
Yeah. So basically, it's like a bank for companies. They invest in a company that's already established in general. They try to figure out ways to add value to that existing company.
Right.
Especially in transportation where those ORs are low. That means that 95 OR, 93 OR you're only getting 7 cents on a dollar. That does not leave a lot of room for investment.
Right.
You can't grow your fleet as fast as you might want to, or maybe you need to. You can't grow technology as fast as you need to. So then they look outside for, investors. Mm-hmm. Private equity firms specialize in investing in companies that way. Now they need to get their return on investment.
I was going to say this. So private equity is they're looking for a return. Usually it's within 3 years or so, right?
3 to 5 years.
3 to 5 years.
3 to 5 years traditionally.
Yeah.
Now, they have trouble in the transportation sector.
Yeah.
So a lot of these private equity companies they'll grow in two ways. One is cutting costs.
Yeah.
So think about this. You're going to invest in a company that's making 5 to 7 cents on a dollar, and you're going to cut their costs.
Mm-hmm.
you don't think they've already cut their costs
Yeah.
like low enough. Like
Yeah.
this is a very tenuous situation already.
Right.
And then you have moments like this in March that happen. So say you've, in the transportation industry, you've noticed this in your brief stint in it.
Mm-hmm.
It's very seasonal,
Yeah.
extremely cyclical.
Yeah.
So you have these huge fluctuations up and down throughout the year. And then on top of that, you have another 5 to 10% that it will fluctuate on any given year.
Right.
So you can't see the highest highs and lowest lows in any given year and apply them to the next year, just like I said earlier.
Yeah.
I mean, I said it, it's fact.
Yeah.
But that is extremely difficult to operate at a 93, 95 OR and be able to flex up and also contract
Right.
with the times.
Right.
So private equity has a lot of trouble with that because they don't understand the cyclical nature of it, the seasonality. I mean, they understand it to an extent, but it's very hard to manage costs in that environment.
Right.
The
I can
next,
only imagine getting in on like a high,
Yeah.
like a seasonal high or something like that, and then thinking like, oh, this is how it's going to be all the time. Like,
Yeah.
no, that's not
yeah.
it.
And transportation companies need to keep this in mind too when they're looking for outside investment.
Yeah.
They need to make sure that they're very clear cut on how they, view these outside investors. Sometimes they're just like, just give me money,
Right.
and
Right.
that's not necessarily the best course of action in the long term. Anyway, so private equity cut costs one way. The next way they do it is they try to find other companies that have synergy that they can pair you with.
That's a nice little MBA word for you. Right
Yeah,
there.
MBA or just general buzzword.
Yeah, buzzword.
That they can combine you with, so you can kind of incorporate, maybe you can cut off a bit of overhead. They have some already existing technology that you could really benefit from, et cetera.
Yeah.
Maybe they're not even a transportation company, but they're some form of commodity producer that you specialize in.
Yeah.
So now you have a transportation provider that specializes in that commodity, et cetera. There's all sorts of techniques and ways that they can make this very
Fold in
profitable.
companies. Yeah.
So what you're doing there is you're increasing your revenue and you're also lowering your cost without actually, trimming that company's costs.
Right.
You're just finding something that can pair well with it. It'll grow the revenue simultaneously as well as making sure that cost. So basically you're just expanding that OR naturally. That's the other method that private equity companies use, and it's that's far more successful in the transportation world.
Yeah.
Even though it's not necessarily the most common,
Right.
term.
Right.
So yeah, I wanted to hit on that real quick, but the financial side of the freight industry, there's a big disconnect between finance and freight operations.
Right.
Just because of the natural disconnect in any industry. I know I was at a supply chain forum here in November,
Okay. So sometime.
and I was listening to a talk, Domino's. The lady that works at Domino's, she was basically, the UTK supply chain forum in November. Wonderful little forum that they give, my alma mater.
Yeah. Yeah.
Just to give them a quick plug. They, she was talking about how they were actively working towards bridging the gap between operational and financial information. And a lot of the times the financial world gets locked into financial metrics, revenue and, costs, et cetera. But that's all based on accounting.
Right.
There's an operational side that you can get into. And some of those operational measures are hard to translate directly into the financial world, if you will.
Right.
It may not show up this month, but it'll show up next month if you're doing it right. Some of these terms like, revenue per driver per week, stuff like that may not necessarily show up. I mean, obviously it'll show up in revenue, but this is the type of, operational KPI that you're looking at that may, it's going to give you a measure of what's happening today, regardless of when they account for it.
Gotcha.
That's basically how much revenue is your driver producing. Doesn't matter how much he's spending you, because let's be honest, you generally know that your costs are about the same in that area, especially when transportation. But there's been a consistent disconnect there. Most financial people look at their accounting metrics. That's what they're comfortable with. There's definitely been a move here in recent times towards understanding the connection between those two numbers.
Right.
So that being said, that'll wrap up our little financial sector.
That was useful. That was some good information.
We've had a lot. We've tried to pack it in this week.
Yeah.
Let's move on to, we've got an interesting market to cover.
Yeah.
Anthony.
Yeah.
I'd like to hear what you've got this week in terms of economic activity.
Yeah, I mean, so it's no surprise coronavirus is here. We have an idea of how it's going to be impacting, I think, the manufacturing segment, especially with, China being such a large manufacturer of goods and industrial stuff. We can take that hit. We've taken that hit since the latter half of 2019. So it was like, okay, we see this. It's still ongoing. That's fine. The consumer is going to be there for us, right? And so now what we've seen in the headlines is the consumer, maybe they're going to be not as resilient because this is a little bit different than a trade war that doesn't really impact them directly.
Consumers didn't care about the trade war.
They didn't care too much. It was like, oh, wait, the manufacturers are taking the hit right now and my goods are still the same price, so it didn't really hit us too much at all, really.
Nope. Didn't care. We saw that this Christmas.
Yeah, it was A-okay.
Right.
But with this is different. Now we're seeing a lot of different consumer behavior. You can go into your Costco. I haven't been in Costco yet, but go into your Costco's and try to find some hand sanitizer, some Lysol, some Clorox, some toilet paper, as we were talking about earlier. There is the actions are speaking for themselves here. And so what we're seeing on the consumer side is going to be telling for the future of the U.S. economy in the coming months. And so one of the areas I'm going to be watching very closely is every consumer-related index or measure that comes out in the coming weeks and months. One of the ones that's really the underpinning for everything, it's not confidence, but I think employment.
That's a good one.
It's a good one. Not saying that's a leading indicator, but it's something to tell us, just like it's like a pulse on the economy. What kind of condition is a consumer in? And so in the most recent number, we saw that consumer strength is going to be underpinned by ongoing low unemployment rates. It ticked back down to 3.5 from 3.6. So that was for the month of February. February was kind of a while ago. So I also like to look at weekly jobless claims. And so that really kind of measures the rate of layoffs in the economy, the demand for labor, if you will. So the pace of layoffs is still low. So we saw that the weekly jobless claims have remained really low. Like consumers aren't losing their jobs. Layoffs aren't picking up in the economy. So people are still in a decent place. And so that really kind of is going to be something that facilitates more retail sales and activity. That's
fascinating to me. It's almost like we are so immune to the headlines now. I think if you look at in the 90s, an era that I grew up in, we were so sensitive as consumers to any negative news. Right. I think we've literally come through. I mean, I think this is going to be telling to see how long this lasts. Of course, we're not that far into it. We're literally only a few weeks into it in America. We've obviously been watching it for a couple of months now. It wasn't actually a huge deal until early February, though, when people started to be like, wait a minute.
Yeah.
This is probably going to get out of China.
Yeah.
It's not but at the same time, I think there's people like me out there that are like, dude, it's a cold. Mm-hmm. If I get sick, okay. I mean, I got 2 kids. I told you the story about how I lost 10 pounds in 1 year because my daughter brought home the flu.
Oh, kids are gross.
And then all the other viruses.
Really?
I weighed as little as I did in high school for a period of time. So I'm literally like, oh, okay, another bug.
Yeah, kids just ramping up your immunity.
Yeah, I think the thing that gets scary is when the news sources talk about people dying, but at the same time, a lot of the people that are dying are also
immune compromised or older.
And I was watching a report on this disease, virus, whatever you want to call it, earlier today, and it's essentially like our bodies don't have any natural built-in memory of this virus. That's why the infection rates are higher than in other ones.
Right.
And of course, with every infection, every virus you get, there is some level of risk for you getting a secondary infection.
Yeah.
You get sinus infections, chest infections, bronchitis, pneumonia, etc. So the more people that are getting infected, the more people have a chance for a secondary infection.
Yeah.
That's just natural.
Right.
So there's going to be more people infected than with the flu.
Yeah.
because we don't have the built-up resistance as a species. And we're going to have more secondary infections.
Yeah.
So those two things being said, I think that's really what's happening out there. But at the same time, how do you put a value on how much you mitigate that?
Right.
You know, you've got thousands of people out there that you could save by slowing the spread of it.
Yeah.
So you're going to give time for, if it does mitigate, it does slow down the progression as the temperature warms up, et cetera. So say you've slowed the progression of the virus, it's not going to peak as high as it did before.
Mm-hmm.
So essentially you're saving lives by
Right.
slowing the progression.
Right.
Again, giving people time, to get ready for it. Vaccines can be developed, et cetera. Seasonal factors,
Yeah.
whatever it is.
Yeah.
So I think that's really what's in people's minds right now. It's not necessarily that, oh my gosh, I'm so worried that I'm going to cough.
Mm-hmm.
It's
I've
more,
seen a couple of stares around the office, like a little cough goes out, and everyone just turns their eyes. Just like, who did it?
yeah.
I think one of the things that we're going to have to be mindful of is that there also are limited test kits that have been sent out already. So I think we'll start to see complete ramp ups in cases as there's more testing. I'm sure there are people all over the place that might have it, but they have not been tested for it. And so I think once that kind of comes out, that's going to really ramp things up a little bit one more time.
For sure.
Um,
Yeah, one more time.
and that will be also telling to see how the headlines really kind of play into that, and then really how that really affects consumer spending and activity.
How do you see this playing out in the consumer realm? I mean, we seem to be. I mean, the numbers are supporting a very stable world right now. Like, we're seeing more to the upside than the downside in terms of general economic activity. Yet the stock market, of course, is looking way
Abysmal,
more, way far ahead in the future, which is going to have an impact. I mean, we're talking about it here about how employees are going to come into the office, et cetera. How are we going to handle travel? I mean, we had this week, I had to cancel some travel plans.
Yeah.
That's money I'm not spending on gas,
Mm-hmm.
food, et cetera, hotel, all this kind of stuff.
Right.
That's going to trickle down eventually.
Yeah.
But
yeah.
and we're kind of pulling forward, like you mentioned before, on things like toilet paper, hand sanitizer, food, all this stuff. So it's offsetting in a way.
Yeah.
But how much does that play? I don't know. I don't know how that plays out.
Yeah, I think it's going to be the data that I am going to be most curious about. It's going to be the March data. So a lot of these major economic releases are going to be a little bit lagged, and they're going to show data points for February, January, things like that. But I think March data is probably where we're going to start to see some of the impact and the consumer side of things. Also, I think one of the areas that we're going to have to watch closely for is going to be in the second quarter. So I think if there is going to be some kind of overt contraction, it's going to be in the second quarter of 2020.
Yeah.
Because I think we came out strong enough in January. I think that strength kind of melted into February. March is probably going to be weak, but good enough to get us through that first quarter, especially with a bunch of the pull forwards.
Yep.
The second quarter of 2020, I think, is going to be really rough and very telling.
I've got a lot of questions about the second quarter. I feel pretty strong about the first quarter this year, obviously after this March, in terms of transportation environment. But I'm really, really uncertain about second quarter this year. I mean, and obviously that depends on what everybody does. I think we're going to see the brunt of the virus come through the United States here in the next few weeks. At some point in April, I believe we will begin to see the downturn. If you look at China and you look at how their curve worked, they kind of peaked out.
The curve that China put out?
Well, the curve that, in terms of infection rates, they didn't put it. Well, they did put it out.
Yeah.
But they had a peak of infection rates around 80,000 cases, and that was 2 weeks ago.
Yeah.
So, 80,000 cases, whatever you want to call it. We know that there's a number there they've probably figured out a way to mitigate it for now.
Yeah.
We kind of peaked and crested, and the virus was just getting going at that point in time. So looking at that number, you're looking at about, a month and a half before it,
Runs its course.
ran its course. And we are, January 19th ish, somewhere in mid-January is when we saw the first coronavirus case here.
Yeah.
I think it was early December in China, in Wuhan. So I guess, by that number, you're talking about 2.5 months. So,
Yeah.
But I'm thinking about more when the virus kind of got going and ramped up. I mean, we're on a different curve than China is because they were the originator. We're kind of the secondary phase. We're also a little bit more prepared because we saw it coming, and we also have better healthcare in this country, presumably. And so I think we're on a little bit of a shorter curve. I think for sure by mid-April we will begin to see this thing kind of fall out, run its course. I'm no virologist though, so don't take that for what it's worth. But I think that we will begin to see that. The problem is, especially for those involved in freight, China volumes.
Yeah.
We're watching our customs shipments.
Right.
They have not recovered yet.
Right.
I know they're reporting that China's back up to speed or closing the gap. That's going to take some time to pull through. Again, depends on how much inventory we have in this country.
Right.
I don't know if I'm pretty sure we have plenty of inventory of toilet paper available. We create that here.
Yeah.
It's not Chinese.
Yeah.
Hand sanitizer we can produce here as well. But at the same time, there's all this other inventory. I'm not sure how much that's getting depleted. It hit at the perfect time.
Yeah.
In terms of everybody being ready for Chinese New Year, trade war, et cetera. We'd already kind of inoculated ourselves to an extent.
Yeah.
I don't know what that's going to look like come April, May. It's because it's going to last throughout the year. We're going to see reverberations for all 12 months of 2020.
Definitely.
Yeah.
Definitely. Yeah. And I think that really brings us towards the end of our show. And I'm a little bit disappointed, Zach, we haven't had a good old-fashioned argument in some time.
So is there something in particular that you wanted to bring up today?
I don't think I have anything.
Do you not have an airing of grievances?
I don't think I have anything. Say something. See if I disagree with it.
I believe that Toys R Us should have succeeded.
I'm with you. I'm with you. I don't believe that there should be so many mattress stores all over the place because I never see anyone in them. I'm convinced it's a cover for some kind of operation.
They always go out of business.
I don't trust them.
They go out of business. It's some of the worst freight you can move.
Mattresses?
Mattresses.
Real.
Trucking
do a
companies
show on that.
Trucking companies hate mattresses.
Really?
They're super light.
Yeah. Take up a lot of space.
Take up a lot of space. I mean, especially on the LTL world, which is where I came from. But
Yeah.
again, even on that, they're difficult to move because they're bulky. You bump a dock, but they're not on pallets.
Yeah.
You have to strap them in a weird way. It's
It
not
sounds like
great.
a nightmare.
It's not great. They're coming up with different ways of doing it, though.
I got mine in a little box.
Yep.
Yeah.
Did you get a purple?
I got a Layla, I think.
Oh,
You can flip it,
Okay.
different sides. Yeah.
Yeah, no, they're
No
getting
plug.
they're getting a lot better.
Yeah.
In the way that they're transporting these things. I mean, and they're also, just getting better in general, as most things do.
Yeah.
Over time.
Yeah. So that's why I don't trust any kind of mattress store in a high real estate value area because I'm just I've seen 2 people walk in the door. One of them was on accident. The other one had to use the bathroom. I don't trust it.
I don't understand how they continue to perpetuate, though.
Same.
There's always a mattress store around.
All right. So no argument today.
No, I guess
right.
not.
Okay.
Well, I feel like we had a pretty good show.
Yeah.
In general, Seth Holm, thank you to him for showing up this week. And, as always, stay tuned to Freightonomics for your freight market economic analysis.
Yeah.
All right, guys. Have a good week out there.
Remember that one time we had to put that coffee down?
Yeah. Some sort of trance music.
And it had lyrics, I think. Lyrics. Shout out to Emma, the intern.
Emma.
We appreciate